Good morning, everyone.
Good morning, sir.
Yeah, good morning. Yeah, we are welcome to another section of the class today. So today we'll be moving to a new topic, different from the last topic we did, which is on value-added tax. Today we'll be moving to company income tax, CIT. It is usually stated as well, CIT, company income tax. So, let me see. I hope everybody has joined. Yeah, okay. Yes, company income tax. As the name implies, company. So a company is an artificial person that is different and separate from its owner. So a company is an entity that is different and separate from those who established or created the company. So that makes it to be regarded as a company. And because it is different and separate from those individual who establish it, it is expected that that entity must also be liable to tax on the operation performed by them. So specifically, the tax law group company into two major types. We can either have Nigeria company or non-Nigeria company or foreign company. We have either Nigeria company or foreign or non-Nigerian company. A company will be regarded as a Nigeria company where that company is registered in Nigeria, where the company is registered with what? CAC, with the Corporate Affairs Commission. So all companies that are registered with our Corporate Affairs Commission, so who has what? The CAC number, are regarded as what? As a Nigerian company, irrespective of whether the company belongs to what? To an indigen of Nigeria or not. Why a non-Nigerian company are those companies that do not register with the CAC, but derive income. They have a fixed base here in Nigeria. They derive income or have a fixed base here in Nigeria. Such companies are what? Are regarded as what? A non-Nigerian company or foreign company. So the profit of each of these companies are liable to tax, according to what? According to the tax law. So for a Nigerian company, so the profit of a Nigeria company is liable to tax on the totality of its global income. That is, a Nigeria company is going to pay tax in Nigeria on its global income. So what do we mean by this global income? On the generality of all the income generated by him, irrespective of whether the income is received, derived, or generated from Nigeria. So it's going to pay tax on what? On the global income. In the case of what? In the case of a Nigeria company. What we may now think about is, so that means if I'm a Nigeria company and I'm receiving income from another country, let's say you are receiving income from UK, the government of UK will not look at me and allow me to go away with such income. They will also tax that income. That means that income will have been subject to tax also in that one, in that country. And you are now saying when I also declare it in Nigeria, you're also what? Going to charge it to tax. So there's going to be what? A double taxation relief that will be what? Granted for what? For any income, for any foreign income that has suffered tax. When what? When such income is what? Is going to be liable to tax in Nigeria. Usually, the double taxation relief is usually what? The tax, whatever tax you suffer in those foreign income on those foreign income in the foreign country will be what? will be given to you as a relief when you are paying tax in Nigeria on that income. But in the case of a non-Nigeria company will be liable to tax in Nigeria only to the portion of what? Of the profit or income attributable to operation in Nigeria. Only to the portion of the profit or income attributable to operation here in Nigeria. Where that particular company does not operate in Nigeria or does not receive any income in Nigeria, such company is not going to be liable to tax in Nigeria. In a car, mute your mic, please. So that is what. So that means, it is only as a non-Nigerian company or a foreign company, it's only income that's what you receive or derive in Nigeria or generate in Nigeria that will be what? Liable to Nigerian tax. Then this company income tax is governed by what? By the Act, by the Company Income Tax Act, which is regarded as what? Cap C21, Law of Federation of Nigeria 2004, as amended, and other finance acts that regulate the activity of what? Of company income tax. And this tax is payable on preceding year basis. That means all your operation from January to December of year 2023 will be liable to tax in year 2024 year of assessment. It's payable on preceding year basis. And this tax is collectible only by the Federal Inland Revenue Service. So they are the tax authority that collects this category of taxpayer from either Nigeria company or non-Nigeria company. So those are the categorization of a company and the process of charging them to tax. Then in the new Finance Act are specifically categorized company into various segments. Before the Finance Act, we don't usually have such categorization. We only have either a company or small company. Abosede, mute your mic. So we only have either small company or company then before the Finance Act. So the small company are usually company with turnover of 1 million naira and below then. But now the Finance Act has specifically categorized company into 3 major forms. And this form also determines the tax rate that will be adopted for this category of company. And this categorization is based on the turnover generated or made by the companies. So the turnover made by the company will determine what will be the categorization. So the categorization, as I said, are now in 3 forms. We have the small company, we have the medium company, and the large company. A company is regarded as a small company where they record an annual turnover. Look at that word, annual. That means from January to December of a particular year. The total amount of their turnover is 25 million naira and below. 25 million naira and below. So that means if you have a turnover of 25 million naira and below, you'll be regarded as what? As a small company. In that instance, the tax rate that is applicable to those companies is what? 0%. If you are saying 0%, that means they are not going to pay tax. So yes, they are exempted from tax because government is using that as an incentive to encourage small businesses. So in order to cushion the effect of what? Of taxation on what? On businesses. So as a result of that, they decided to what? To exempt them from payment of tax. Then we also have the medium company. So these are company with turnover of what? Above 25 million and less than 100 million naira annually, with annual turnover of what? Above 25 million naira and less than 100 million naira. So this category of company, they pay tax at the rate of 20%. So their own tax rate is 20%. Then why the last categorization is a large company. Then for large company, these are company with turnover, annual turnover of what? 100 million naira and above. Annual, from January to December, turnover of what? 100 million naira and above. And their tax rate is what? Is 30%. So this categorization is needed for you to be able to know the tax rate to be adopted when you are asked for the computation of tax liability. Because if you have a company that is what? Having a turnover of less than 25 million, so you should be, instead of adopting 30%, you should be able to know that what? You are not going to what? Charge them to what? They will be exempted from payment of tax. Also, you may have a scenario whereby the examiner, we have three rates here now. Either 20% or 30%. You may have a scenario whereby the examiner will not give you information about the level of turnover generated by a taxpayer. So the examiner may not give you information about the turnover. So when we have that, so that should not be a dilemma to us. So we are going to what? Assume what? Large company. In that case, we adopt what? 30%. So the rate to be adopted will be 30%. So any question? Any question? Okay, let us continue. So we now need to look at these companies one after the other. So based on what? Based on their categorization. So the first categorization was small company. So this is according to what section 23 of CETA, small company. So section 23 gave us what? The rule that guide what? The operation of what? Of small company. So some of these rules are what? Small company. So those are what? They are companies that are what? Exempted from where? From payment of tax. So they are not going to pay tax because they are small company. But the law proceeds further. The fact that they are exempted from payment of tax does not exclude them from where? Registration for tax. So you have to register with the relevant tax authority. It's just that. Sorry, I think the network logged me out. So this company are also, as I was saying, this company are expected to register for tax with the relevant tax authority and are also expected to file annual return. But the tax law provided that they may file a FRS, the tax authority, which is Federal Inland Revenue, may specify a lower return to be filed for them. So when they say a company is filing return, so filing return means that you are giving them, you are submitting the component of your audited financial statement. So we know the component of our audited financials. So which are what? We have our statement of what? Financial position, the statement of the profit or loss, and comprehensive income. So we have note to the account, changes in equity, and all those information, cash flow statement. Those are what? Items of what? Annual return. So, but the tax law gave what? Small company the right to file what? A lower return as part of what? As part of their annual return. Then also they cannot what? They cannot charge what? Withholding. They cannot charge what? Withholding tax. But there is a condition to that. They cannot charge withholding tax. They cannot deduct withholding tax. provided that the supplier is having a valid TIN number. So if you are a small company and you are dealing with a supplier, if the supplier is having a valid TIN number, you are not expected to charge withholding tax. And the transaction value does not exceed 2 million naira in a calendar month. So in that case, they cannot charge withholding tax. Also, small company, because they cannot charge, that does not mean that they may not be liable to withholding tax, because as a small company, no law says that you as a small company, you must also deal only with small company. Small company can decide to deal with either medium or large company who are mandated to deduct. So that means they may also suffer withholding tax. So any withholding tax, where they suffer withholding tax, they are liable to refund of such taxes suffer in form of in form of withholding tax when they deal with either large company or medium size company. Then we have so then after that we are also expected to note that this small company, they are granted exemption, as I said earlier. So they must so they must file return for that exemption to be. So if you fail to file return, so that means you are not going to pay tax, but you'll be liable to penalty for failure, penalty for failure to file return. So which is an offense according to the tax law. All companies that are registered in Nigeria are also expected to pay tertiary education tax. There is a tax which is called tertiary education tax, which is either at the rate of 2%, 2.5%, or 3%, depending on the year of assessment. So these companies now, so they are small companies are exempted from tertiary education tax. Take note of that. So because they are exempted from tax, from company income tax, so the law also goes further to exempt them from tertiary education tax. Also, the law also exempt them from payment of minimum tax. They are also not going to pay minimum tax. So minimum tax is a form of anti-avoidance technique that is introduced by the government to get in order to get revenue for the day-to-day activity. Because government knows that some taxpayers, they may decide to make use of a lot of available relief that are available. And by the time they make use of those relief, they may end up not having a taxable or total profit, which in the end will make them not to be liable to any tax payment. So as a result of that, government introduce minimum tax in a scenario whereby you don't have taxable or total profit. But small companies are exempted from this form of taxes. Then we also have small companies, they will also make use of of qualifying capital expenditure for the purpose of business. They will also use qualifying capital expenditure to carry out their business activity. And we know when you utilize qualifying asset for the non-current asset for the purpose of your business, you will be entitled to capital allowance claim. So also the law, since you are not going to pay tax, the law is also saying that small company will not be liable to claim capital allowance. They cannot claim capital allowance. So they can only claim capital allowance when they either move to medium or large on the unexpired useful life. So that means during the period that they are small company, they are not liable to payment of or to claim of capital allowance. Sorry. So in that case, capital allowance is not available for claim. So the capital allowance will be available only when they move from a small to either medium or large company. Then we also have because government knows that when this law came up during the Finance Act in 2019, government knows that taxpayers are very smart. Some directors of company or owners of business may decide to use this provision as an avenue, not to what to evade tax by trying to what ensure that they don't want to pay tax. In that case, some of them they may decide to what to go and float or to go and register with various businesses, and they ensure that the turnover of those businesses does not exceed 25 million in order to avoid the payment of tax. So where this occur, because government knows that some taxpayers may want to do that, government now establish what is called Anti-Abuse Act. So this Anti-Abuse Act is to what? Is to look at what? The process of what? Of engaging in that activity where the shareholders or the owners of a company decided to float or establish various company for what? For the purpose of for doing the same businesses in order to avoid what? Payment of tax. So when this occur, so what government is going to do is that they are going to disregard those companies as what? As a single entity. They are going to regard those companies as what? As a single entity. As they will regard them as what? As separate entity, and regard them as what? As a single entity for the purpose of tax liability. And it is also what? A punishable offense, which the director will also be what? Liable and what? And so for doing those activities. So any attempt by the owners of business to float various business for the same purpose in order to avoid payment of tax will be what? Will be gotten by what? By the Federal Inland Revenue, and what? And various or sanction will be what? Will be implemented on what? On the company. So any question? So any question? Then let us proceed. So then what? So this company income tax now. So what are those that are liable to what? Company income tax? So the company income tax so is payable by what? The company in his own name. Company can pay it in his name. Is liable in the name of his principal officer, attorney. If the company also, if they what, they also appoint an agent or a representative that is working for them here in Nigeria. So where they are receiving income, so they will be liable to tax in the name of what? Of that agent. Also in the name of what? A receiver or a liquidator, where the process of what? Of liquidation is being what? Exercised by what? By the company. So in order to liquidate the company operation. So those are the what? The way a company will be what? Will be charged to tax. So after that, so we now have what are the basis? So what are the way of computing this company income tax? Basis of computing company income tax. So basically, there are 4 bases of computing company income tax. There are 4 ways to compute company income tax. We have a total profit basis, we have minimum tax basis, we have turnover basis, and dividend basis. So each of them, so we have the total profit basis according to section 31, minimum tax basis, which is according to section 33, turnover basis according to section 30, then dividend basis according to section 19 of CETA. So all these 4 bases are the way in which the tax authority can adopt to determine the company income tax liability of a taxpayer, which is what? A company. So we are going to look at this basis one after the other, one by each. So this basis will be look at one by each. Then in the case of the first one, we have a total profit basis. Total profit basis. Under the total profit basis, there are 2 approaches. So we have the turnover approach. We also have the net profit approach. So under the total profit basis, we have the turnover approach. and the net profit approach. So those are the two approaches available under that basis. So either of the basis adopted, it will give you the same answer when you have all information correct. But please, the utilization of each basis depend on what? On the information provided. Where we are not giving information about net profit, that is when you have to adopt the turnover approach. But please, when you have information about the net profit, where the examiner give you information, the value of the net profit, please, you don't adopt the turnover approach, because you may not have sufficient information to adopt the turnover approach. So where the examiner wants you to use the turnover approach, it's not going to give you the net profit at all. It's not even going to give you a clue on how to calculate it. So in the exam hall, don't go and do what? Don't go and do accountant for what? For the examiner by saying what? You want to first of all calculate what? The net profit. So under the net profit approach, how do we determine what? The total profit and the tax liability for relevant year of assessment. So that means for the net profit approach to be adopted, we must have information about the net profit. You state that out. We have the net profit reported in the question. So you write that out. You now add what? Add back. You are going to add back. You add it to the net profit, disallowable expenses. There are some expenses that are called disallowable expenses. So we add back those expenses. Then we also add back taxable income omitted or not recorded, not reported. So taxable income omitted or not reported. So we also add those back. So some taxable income that are not recorded when we were calculating our net profit. Then you less or deduct non-taxable income included. Less non-taxable income included. Non-taxable income included with less. You also less allowable expenses omitted. We may also have some expenses that are allowable that are omitted. You also less those expenses. So you add up the addition, the two, you also deduct the two, yeah. So the total figure will be transferred to net profit side to know the final figure. So the final figure will now give you adjusted stroke assessable profit. Please, for company income tax, your adjusted profit is also the same thing as your assessable profit. For company income tax, this is only what applicable for company income tax. So adjusted profit is also what? The same thing as well, assessable profit. Then we talk about, earlier we did loss relief. It is possible that the company is having what? Loss that they are bringing from previous year that they are yet to relieve. If there's any, you consider those losses, any amount brought forward, you look at it, loss for the year, then total loss, then amount to be relieved in the year. So you look at how much are you going to relieve in the year. If the accessible profit is not sufficient for it, you carry the balance as what? Unrelieved loss carried forward, which is what? Which will be here. So all this will be what? Will be for the losses. Then after the losses, you have what is called a balancing charge. We know that under the tax law, when there is disposal of qualifying capital expenditure, so the disposal will give rise to either balancing charge or balancing allowance. One is an income and one is an expenses. We know already that balancing charge is an income, while balancing allowance is an expenses. So because balancing charge is an income, so if you are giving the question, so any income that is balancing charge, you add. You add it after you have considered the loss, after you have relieved the loss from the accessible profit, then you add the balancing charge. Then after adding the balancing charge, you also look at the capital allowance itself. So the capital allowance, that may be the one you are bringing from previous year, the one brought forward. Then you also have a capital allowance for the year, any amount for the year. Then balancing allowance, if there is any balancing as a result of a disposal, Then you add up the three to get your total capital allowance. So this total, you have to what? Relieve it. This total will be relieved. We know that capital allowance is usually restricted to what? 66 to third of what? Accessible profit. So at this level, they are going to restrict it to what? To third of what? This accessible profit. The only time you are not going to restrict is what? Where if the company is what? Is into what? Manufacturing or agro-allied or agricultural business. So in that case, so you relieve what? Restrict to what? 66 to third. So any bank, so if the money is, if the amount is what? Lower than this, so you consider that and transfer to this side, then that will give you what? Unrelieved what? Amount carry forward. So you look at the unrelieved amount. Then after that, you have what? Total profit. So the resulting, the final figure will give you total total profit or taxable profit. So which can either be what? Law. So we can also be what? Nil. In scenario whereby what? You have your capital allowance has taken up what? The total amount. So in that case, so you now calculate your what? Your company income tax at applicable rate, depending on what? On the level of turnover. And don't forget, I told you where you are not giving what? The turnover, the level of turnover, we adopt what? 30%. Then you also calculate what? Tertiary education tax at what? At the applicable rate, which can either be what? 2%, 2.5%, or 3%. So depending on what? On the what? The scenario available. So that's how to what? To adopt what? The net profit approach. As I said, please, where the examiner did not give you information about the net profit, please, you cannot adopt. So you cannot what? So don't calculate the net profit for the examiner. Don't do what? Don't do accountant for the examiner by saying you want to calculate it. By all means, adopt other approach. So which can either be what? The turnover approach. Then we have what? We have the second approach. We have what? This, apart from the turnover approach, we have the second approach, which is what? Which is, apart from the net profit approach, we have the second approach, which is what? Turnover approach. So I think that one is not in the material, but let me analyze it here. So we have a net turnover approach. So how do we adopt the turnover approach? So adopting the turnover approach, so this one will be used where you don't have information about the net profit. In that case, so you look at your gross turnover. So your gross turnover, you look at the total gross turnover. Then you now less frank investment, you less frank investment income, you less FII. So, and if the FII is included in the gross turnover, so you less it included. So you less any FII included in the turnover, you less it. So after lessing it, so you have what? Net turnover. So you now less what? All allowable expenses. So all the expenses that are allowable, you less all the expenses from your net turnover. So you less these expenses from your net turnover. So the resulting figure will give you what? Adjusted stroke accessible profit. So when you get to this level, so adjusted stroke accessible profit. So when you get to this level of adjusted stroke accessible profit, so the procedure continue as the same. So after this level, according to the format, so what we have is what? You now say less what? Less loss, relieve. So you relieve your loss, less loss, relieve, add balancing, charge, then less capital allowance. So all this information will be left to get what? Taxable, or total income. So when you have the same scenario of question under another circumstances where all the information are given in the question, the answer to when you use either a turnover basis or when you use a net profit basis will give you the same final solution. It give you the same final answer. So that is what in the case of the turnover basis. So any question? Any
What is
question?
that under, sir?
Okay.
That gross turnover format.
Yeah.
You said less. I don't understand that one. Less F11 something.
Let's frank investment income,
Oh,
FII,
okay.
frank
Okay.
investment income.
All right.
We
Thank you, sir.
know some income are frank investment. So who can give us an example of frank investment income?
Dividend.
Dividend.
Dividend, yes. We did it when we told intern. Dividend. It's a good example of frank investment. So you let it dividend. So you let it to get or so. Either you use that or you use your net profit. So the resulting figure will give you the same amount. So any other question? Then let us continue. Then we need to look at this analysis. Before we go to the next basis, we need to look at this analysis one after the other. So we're going to consider allowable expenses first. Allowable expenses. For any expenses to be regarded as allowable expenses, that expenses must be run for the purpose of the business. That is, that expenses must be wholly, reasonably, necessarily, and exclusively incurred for the purpose of the business. So the expenses must be run for the purpose of the business for it to be allowable expense. Any private expenditure are not allowable. They are disallowable expenses. Their contribution to what? To pension fund approved by the joint tax board. You know, now we have what is called the contributory pension, whereby both the employer and the employee will contribute towards the pension of the employee. So any contribution made by the employer is an allowable expense, provided it's approved by the joint tax board. Then there is no tax law that says if you want to do a business, you must use your fund. You can decide to borrow money to run your business, to do business. So when you borrow money, you are going to be paying interest on that money borrowed. Any interest on loan gotten for the purpose of the business will be an allowable expenses, subject to related party interest. So when you borrow any money for the purpose of doing business, the interest you are paying will be an allowable expenses. All amounts will be allowable when you are computing your tax liability. Then bad debt written off, provided the following conditions are met. Bad debt written off, that must be what? So the debt must have been included as part of the sales in the year of occurrence of the debt. So that debt must be part of the debt of the company. It is what is given right to the bad debt is as a result of what? Inventory or their sales. Then all necessary then B, the debt must have been included as part of what? As part of the sales in the year of occurrence. Yes, it must be part of the sales. No deduction must have been made in respect of the debt before. You must have not deducted anything. All necessary efforts must have been made to retrieve the debt for proof abortive litigation. So you must have taken the person to court. You must have done all means to recover the debt, but the person still refused to pay. So in that case, so any bad debt written off from that scenario will be allowable. Then the taxpayer must have undertaken unreasonable step to prove that is what in the case of that. Then we also have that is for them. Then we have tax rent of accommodation, rent. Any rent that you are paying for the for either for the purpose of the business or for your staff. So in the case of rent for staff, provided what the amount of rent you are paying does not exceed what the basic salary of the staff. Then we also have a provision for bad and doubtful debt. Under the provision for bad and doubtful debt, we have what the general provision and specific provision. We have general and specific. So please, it is only what the specific provision that is what allowable. So where it is general, that will be what disallowed. It is only specific that is allowable. But you may have a scenario whereby the examiner will give you a question. He will not tell you whether it is what specific or general. But in that scenario, we assume it is what it is general and what we disallow. Then legal expenses in relation to what? To general legal advisory fee. As I said, so every company, when you incorporate a company, you are expected to part of your members, part of the people that must be part of the members of the company are director. You must have what a secretary who is usually a lawyer, or you must also have what an auditor, external auditor. So those three are what the component of what of an auditor of what of a company, members of a company. So any money you are paying to what to the lawyer as your company lawyer is what is an allowable expense. Also, it is also expected that yearly you will be paying him what retainership fee is also allowable. Any cost of what protecting or defending the business is also what allowable. Renewal of short-term lease. Under the lease, we have what lease can either be long or short. Please, it is only what renewal of what short-term lease that is what allowable. Then rent and premium of any land occupied by the business. I mentioned that earlier. Rent for any business operation. The cost of gift to customer, incorporating element of advertisement. When you are giving your customer a branded gift, so that is showing your advertisement, is also allowable since it is branded. So those are so, and also so we also have what donation. So donation is also what to accredited body. So all these are what allowable expense. So for you to say an expense is allowable, it must be what rent for the purpose of the business. It must be wholly, reasonably, exclusively, and necessarily incurred for the purpose of the business. So as I was saying, we also have a donation. So the donation is also what subject to what certain condition. So there are certain body that what donation has to be made. It can either be what educational body, it can be what religious body, it can be medical research, it can be religion, it can be other. So all this body, so where donations are made to them, they are what allowable for tax purposes. Then the one that is peculiar to us is what ICAN, donation to ICAN. So, but that word, please, you have to be vigilant. The one that is allowed is what ICAN building fund. So instead of charter accountant building fund, that is the donation that is. That word building fund must be what? Must be in front of what? In front of that word, that donation. So specifically donation to ICAN, the body ICAN, which is not building fund, is not allowable. But it is what donation to what ICAN building fund that is what allowable. So donation to what some Christian Council of Nigeria is also allowable. But donation to church, individual church like what? Donation to Catholic church, donation to Redeem, donation to Winner, those are what? Not allowable. Then donation to what? MSS and Muslim Society Association of Nigeria, so Muslim Student Society of Nigeria is also allowable. Donation to individual mosque, Nasfat, Korib, and so on and so forth are not allowable. Specifically, so for you to make donation, it must be what? Part of the body that are lifted under what? Under the fifth schedule of what? Of the SITA. Then what are the conditions for what? For allowing this donation? So one of the conditions for allowing donation is that the donation must be made from profit of the company. But before I mention this condition, I also need to let us know that a company specifically can make what? 4 categories of donation. So there are 4 categories of donation that can be made by a company. So one of them is what we have donation to what? Accredited body. So those bodies that are accredited. We have donation to what? Tertiary institution, other university, donation to university, other tertiary institution and research institution. 2, we also have donation for R&D, donation for research and development. Then we have what? Pandemic or government established fund, e.g. COVID-19 donation. So those are the 4 categories of donation that are acceptable by what? By the tax law. So all these 4 categories has condition. But irrespective of the category, any form of donation you want to make, the donation must be what? Made from the profit of the company. You must be reporting a profit before you can say that you are donating. When you made from the profit of the company, then the donation shall not exceed 10% of the company's total profit for the year of assessment before any deduction for the. So the donation must not be more than 10% of the total profits. Total profit for that year of assessment before allowing any form of donation. Before you can charge any form of donation, you calculate the 10% of total profit. So this 10% is specifically applicable to what? Accredited body and R&D. This 10% is what? Is applicable to R&D, research and development, and accredited body. Then we also have what? Donation to tertiary institution or university or other research union must not exceed 15% of total profit or 25% of tax payable, whichever is higher. 15% of total profit or 25% of tax payable, whichever is higher. So that means before you can finalize this, you must also know how much is the final tax. So under the donation to what? That is for what? University, other tertiary institution, and research institution. Then we also have donation must not be capital in nature, except the one you are making to what? University, other tertiary institution, and research institution for research and development purpose. So that is the only one that can be capital in nature. You cannot donate a house and say one. So that is not allowing. So it has to be made to a public fund or statutory body established under the 5th schedule. So that will be made to all those bodies that are established under the 5th schedule of the law. So why also in the case of the pandemic or COVID-19 or government establishment, that one it must not exceed 10% of accessible profit after allowing all allowable donation. So donation for pandemic or government established fund must not exceed 10% of accessible profit after allowing all allowable donation. Then I also made mention of research and development. That must not be more than 10% of the total profit before any donation is made for research and development. So we're in a scenario where you have research and development and other form of donation. So research and development will be deducted first before the other 3 form of donation. Also, we are a company. You have a company, and the company is engaged in research and development for commercial purpose. That is their major work. So any donation they also make, they are going to get an incentive of 20% investment tax credit of of the expenditure that they incur in form of donation that they also carried out. So those are the allowable expenses. Any question? Any question? Then we also have disallowable expenses. Disallowable expenses. So as the name implies, so those are the expenses that we are going to add back. So number 1 disallowable expenses that you can think of is what? Depreciation. Depreciation. Why? Because that taxpayer is going to be given capital allowance. So they cannot give you capital. You cannot claim capital and also claim depreciation again. So depreciation is what? Is number 1 disallowable expenses. Then we also have expenditure of a capital nature because it will be capitalized. Any private or personal expenses provisional item, any form of provision, general provision for bad and I made mention of it earlier. We can have either specific or general. So the general one will be disallowed. Any sum recovered under an insurance or contract of indemnity, yes. So when you receive a claim from an insurance, it's also disallowable. Then any sum recovered out of profit, out of profit, any withdrawal out of capital, any contribution to unapproved pension scheme. So where you have contribution to unapproved pension scheme, so it will also be one. So how do we know whether it is approved or not? So please, in the exam, where the examiner give you contribution to pension, so it is assumed that it will be approved. So where it will not be approved, the examiner will prove that word unapproved there. So then we have a fine and a penalty. The government did not ask you to go and commit an offense for you to be fined. So as a result of that, it is also disallowable. Preliminary or pre-operational or formation expenses. When you are floating your company, any expenses you incur to form those companies are called preliminary expenses. Because these expenses are usually capitalized in the book of the company, so and they are usually written off, so it will not be allowed as an allowable expense. Then we have we have loss on disposal of non-current asset, loss on disposal of investment, because it's not your business to dispose of your assets, to dispose of your non-current asset or your investment. Any loss that you incur from it will be disallowable. Then we have legal expenses in the following regard. When we talk about allowable, I mentioned something about legal expenses, which is what? Legal expenses relating to what? Renewal of short-term lease. That is the only one that is allowable. So now, legal expenses, we can have acquisition and renewal. So we can have acquisition of long-term and short-term lease. Then we can have a renewal of short-term and long-term. Only renewal of short-term lease is allowable. So whatever form of legal expenses that is in form of lease, whether acquisition of long or short, is what are disallowable. Then renewal of long-term lease is also what? Disallowable. In the exam, the examiner may also give you a question and it will just tell you what? Acquisition of lease or renewal of lease. It will not tell you if it is short or long. So in that scenario, where it is not specified, you assume it is what? It is long. Then you what? You disallow such expenses. Then we have what? Cost of what? Cost of defending a tax appeal. So the government did not ask you not to pay as at when due. So any cost of defending it will be what? Disallowed. Then we have a stamp duty on increase in share capital. It's also what? Disallowable. Then we have a defalcation by both junior and senior staff. So this is expected to have been covered by what? Contract of indemnity. So any stealing by what? By staff. So whether senior or junior staff are disallowable. Sorry, I'm coming. Then we have what? Gift and what? Gift and entertainment. So gift. So we mentioned some gift earlier. So, and I told you where it is branded, it will be what? Allowable. Where it is not branded, it is what? Disallowable. Then gift can now be in two forms. You can have gifts to what? Staff and gift to customer. Please, any form of gift to staff, whether branded or unbranded, are allowable. Gifts to staff, any form, whether it is branded or it is not branded, are allowable. So to customer or other people, so it is only what? The branded one that is what? That is allowable. Then we have what? Entertainment. So it can be what? Entertainment to customer or entertainment to staff. So during meeting, usually companies that usually do meeting on Monday, after the end of Monday meeting, so the next thing, they will share item 7. So all those are allowable. So entertainment to customer also what? Allowable. Once it is what? Business related. So except when it is not business related, you are entertaining your friend or any person that is not business related, that will be what? Disallowable. Then we have what? Loan written off. Loan. So any form of loan, whether our loan to staff, or loan to customer written off will be what? Disallowable, except if the company is what? Is a financial institution. So because that is what? The nature of their job. So giving loans. So and they will have what? They will have, that is their own what? Inventory. That is their own stock. As a result, part of their stock, as a result of that, it should be allowable for it. But if it is not a financial institution or other financial institution that give out loan, other company, any loan of whatever form written off will be what? Disallowable. The only one that will be written off that will be allowable is a bad debt or written off. Then traveling expenses of traveling from home to office by employer are not allowed. So to leave your office, to leave your house to the office, they are not allowed. Then, but expenses that you incur on the job as a result of performing your activity are allowable. Then advertisement. So advertisement, where the advertisement is what? Is capital in nature. That will be what? Disallowable. But where the advertisement is what? Is not capital in nature. So that will be allowable. For instance, a company went to a radio station or television station, and they now ask question about their product. That anybody who answered the question correctly will be what? Given a recharge card. Such are allowable. It is only those that are capital in nature that will be what? Disallowable. Then we have removal expenses to new business premises. So when you are expanding your business, it's also what? Disallowable, because you are adding more value to it. Then foreign exchange losses. So under this foreign exchange, you can have gain and losses. So foreign exchange, when it is gain, that is what? Income. When it is loss, that is what? An expense. So foreign exchange losses, please, where you are giving foreign exchange losses, where you are told that what? It is what? Realized. Foreign exchange losses, realized, will be what? Will be allowable. Then foreign exchange losses unrealized will be disallowable. So you may also be given a scenario whereby what? The examiner will not tell you whether it is what? Realized or unrealized. So where the examiner is silent, you assume it is what? Unrealized and what? And disallow such foreign exchange losses. Then why it is in the case of gain too, where it is foreign exchange gain, so it will be a taxable income where it is that is realized. Foreign exchange gain realized, it will be taxable. Foreign exchange gain unrealized will be non-taxable. Then we also have educational training. So education, so your company is paying for your what? ICAN tuition fee as an accountant and so those are what? Allowable. But where the money they are spending for your educational training is for you to gain what? New knowledge. For instance, you are an accountant. Your company now wants you to be what? To be a doctor. They now send you to school to go and what? Learn what? To go and learn medicine. So that is what? That is not what? Job related. Where it is not job related, it will be what? Disallowable. Then any form of subscription made by a company to what? To recognize body. So recognize trade association or recognize will be allowed. So subscription also made on behalf of what? Employee to what? To recognize professional body will also be are also allowable. So any question? Then we also have taxable income. So these are income that we are going to be liable to tax in the hand of what? In the hand of the company. So we have the revenue or turnover, discount received, balancing charge, bad debt recovered, any debt that has already been written as debt. We have allowed it. If we now recover it back, it will be what? It will be taxable. Then any reversal into income of a previously allowable expense, decrease in what? Specific provision for doubtful debt. When specific provision will have allow it as an allowable expense, when there is now a decrease in it, so it's going to be what? A taxable income. Then some of them that may be omitted, they may omit some income from where? From the turnover, so you add them back. Then or understated of sales figure. Then we also have non-taxable income. So these are income that are not liable to, that are not expected to be taxed under the company income tax. Any profit on disposal of fixed asset, any profit on disposal of investment, frank investment income, any income that are when you suffer tax at source. In case of a frank investment income, dividend, so they are going to be exempted from, so deducted for as well a non-taxable income. Then any reversal into income of a previously disallowable expense. So that is what increase. So this is supposed to be increase in what specific provision, decrease in general provision. This one is decrease in specific provision. This is now decrease in your general provision for doubtful debt. So this will be non-taxable. Interest received from federal government bond, any form of bond, but belonging to the government. Because you are making fund available to the government, any interest you receive from it will be what? Usually what? Non-taxable. The illegal income, right? So the any tax exempt income are also so all those are what? Non-taxable income. So any question? So all this income now, so that we said are non-taxable income. So what we are going to use to
Hello, sir.
determine your tax. Yeah, okay. I'm with
Sorry, I
you.
wanted to ask a question. My airport disappointed me. Yeah, I want to ask a question on that defalcation. You know, previously you told us that defalcation is only allowed to is allowable for junior staff and is allowable for senior staff. But here you are now saying both junior and senior staff defalcation is not allowed. So can you justify this? Sir?
Who told you that? Who said it?
Yeah, in the previous lecture, when we were solving the question, defalcation on
Which question?
junior
We have
staff
not
was not
solved.
recognized.
We have not solved. We have not
Yeah,
solved any question.
we solved the question on personal income tax that involved
Okay.
defalcation
That
of
is the other lecturer, Mr. Idris. Mr. Idris. On personal income tax, Abi? When you solve question on personal income tax, Abi?
Yes, sir. Yes, sir.
Was it when you solve question on personal income tax, Abi? That was then, Abi?
Yes, sir. Yes, sir.
Personal income tax, don't forget, relate to individual. This is what company. Do you get it? Because for company, it is expected that the company, they are going to enter into what is called what? Insurance business. They are going to insure their business. So, and if you insure your business as a company, it's different in the case of individual. So that one is relating to individual. But for company are going to insure their business. And once you insure your business, that means you are going to be what? Entitled to what? To what? Claim when anything happen. So if there is any defalcation, whether it was senior or junior staff, it will what? It will be disallowed because what? The insurance company is going to pay you what? A claim. Part of the law is that a company must what? Insure their business. It's different from when you have what? Under personal income tax as an individual. So that's why you have it as well. That's why when you did personal income tax, it was stated as well. Junior and senior, different. But under company, so it will be what? Both. So because your insurance business are what? So you are going to engage in what? Insurance policy to ensure that your business. Is that clear to you?
Yes, sir. Thank you, sir.
Yeah. Any other question? Then for related party, any expenses they have to incur must go in line with what? With the that's what we call transfer pricing regulation. So transfer pricing, at this your level, under your PM, you will have area of transfer pricing. So whereby what they sell what? Goods or services to themselves between holding and subsidiary. So any expenses incurred within or outside Nigeria must be in line with transfer pricing regulation. So where it is not in line with that regulation, that expenditure will not be allowed. Then I made mention of a particular section earlier relating to what? Relating to a particular expenses earlier, which is interest. When we were talking about the allowable expenses, which I said no law says you must use your money for the purpose of business. You can decide to borrow money, And when you borrow money, you are going to pay interest on that money borrowed for the purpose of your business. So there is now what? Restriction or what? Deduction of interest according to what? Section 24 of CETA, where the interest, where the what? That loan is between what? Related party. So where a parent company is giving loan to their subsidiary. So this restriction is only applicable where the loan is between what? Related party. But when you are borrowing a loan from an outsider, no restriction will be what? Will be adopted. So what the law is now saying is that when the loan is between related party, so that amount that will be allowed will be restricted to what? 30% of your what? Of the company EBITDA. It will be restricted to what? 30% of the company earning before interest, tax, depreciation, and amortization. Why? Because some company, especially multinational, they use this as an avenue to what? To reduce their tax liability or to take fund away from Nigeria to other countries, because all countries of the world don't have the same tax rate. It is possible that since we are using 30% as for large company here in Nigeria, maybe where the other parent company or the subsidiary company is that is giving them loan, the tax rate there may be what? Maybe lower. So where the tax rate is lower, that means the company is going to benefit more as a result of what? As a result of that interest, because the interest will be what? Allowable in what? In their book. So as a result of that, so that is why what? The interest amount will be restricted to what? Only 30% of EBITDA. Only 30% of what? Earning before interest, tax, depreciation, and amortization. Also, any balance, it is possible that maybe if the amount happen to be 60,000, when you now calculate your 30% of your EBITDA, it's now giving you, let's say it's giving us 40,000. So that means you have a 20,000 balance. So that balance is not going to be written. So that balance, you have a right to what? To transfer it to what? To subsequent year of assessment for a period of what? 5 assessment year. You can transfer it to what? To subsequent year of assessment for a period of 5 assessment year. After the assessment year in which that interest on loan, that activity occur. So you have a right to transfer it to the next 5 years after the assessment year on a what? On a first in, first out basis, on a FIFO basis. So you transfer it to the subsequent asset on a FIFO basis. So that amount you are carrying forward is also going to form what? Interest in what? In the subsequent year. So if you fail to what? To apply this condition and what? Well, and you borrow yourself loan there are loan between parent and subsidiary. There is also a penalty that is what? That is applicable to what? To that scenario. So, and it is not all entities that are what? That are subject to what? To this condition. All what? Entities that are subsidiary, that are related, that are subject to this condition. Some entities are what? Exempted. So which are what? So in Nigeria, so the entities that are exempted are what? A Nigerian subsidiary of a foreign company who is engaged in what? In the business of banking or insurance. A Nigerian subsidiary of a foreign company. Nigerian subsidiary of a foreign company who is engaged in what? In the business of banking and insurance is what is excluded from this rule. So where you are told that so the subsidiary in Nigeria, so is what they do is what? Banking or insurance, please. This rule will not be adopted, even though if they borrow themselves money. So that means what? We are going to what? We are going to charge everything in full. So it will not be adopted for this category of taxpayer. And how do we calculate this category of tax? So to get your, I said 30% of EBITDA depend on what? Information given to you, either where you are giving net profit or accessible profit. You have to watch out, because if you are saying EBITDA, so that means EBITDA is what? EBITDA is profit before interest, tax, depreciation, and amortization. And if you are giving net profit, so net profit is what? Profit before tax. So that means what? You are going to add back your interest, you add back your depreciation, you add back your amortization. Then if it is net profit, you are not going to add back tax. But if you are giving profit after tax, so you add back what? Tax to get your EBITDA. But if you are giving your accessible profit, you know, under your accessible profit is gotten as a result of what? Adjustment made to get what? To get the amount. So because you have already adjusted that amount, that is going to give you the that means before you can get accessible, you'll have added back your depreciation. That means to now get EBITDA, you are not going to add back depreciation again. What you are going to add is only what? Interest. Interest is only what you are going to add back to get what? EBITDA. When you are giving what? Accessible profit. So not because you will have what? Adjusted it against your what? Against your what? Your depreciation before arriving at what? At accessible profit. So any question? So there's a question that came out in November 2021 on this one, interest deductible rule section. So of that section, so which came out in that year of assessment, section 24, so in that year of assessment. So let us look at the question to illustrate this one, this interest deductible. Question 1, tax November 2021 die. SYZ Limited was incorporated on August 31, 2012, and it commenced business on May 31st, 2013. Dicky Malaysia is a subsidiary in Malaysia. An extract of the financial statement of SYZ Limited for the year ended December 31 revealed the following: net profit. Under here now, you are giving net profit. Interest and depreciation deducted before arriving at net profit of 2 million as follows. It's supposed to be net profit. As follows: interest on loan paid to Dicky Malaysia, other creditor depreciation. Based on the information provided by the company, it was discovered that out of the loan paid to other creditor, 450 was in respect of loan obtained to generate tax-exempt profit. The managing director of SYZ Limited approached you as the tax consultant to explain the provision of Section 24 of CETA as amended and the 7th schedule, the rest interest deductible by a Nigerian company. Required: A, compute the interest deductible in the relevant assessment year. B, explain how the excess interest not deducted in the relevant assessment year will be treated. Then C, compute the tax liability for the relevant year of assessment. So if you see a question, how do you know that this question is on what? Interest deductible. You can see they are talking about interest, and they are talking about what? Holding and what? A subsidiary. Dicky Malaysia is subsidiary in what? Malaysia. So the holding company is what? Is here in Nigeria. That's why I said, so that is what? That is a connected activity, and they borrow themselves loan. So that tells you that what is a related party transaction. So you must what? Adopt that principle of what? Of 30% of EBITDA to get what? To get the interest deductible. And under this rule, we are giving information about, oh, sorry. Then we have what? Interest. So we are asked to, so we are giving information about net profit. So since we are giving information about net profit, so we need to so how do we go about computing what? This information relating to so compute. So we are asked to compute the interest deductible. So how do we go about it? So let us look at the analysis. So let us So I'm going to share our Excel so that we can, I hope you can hear me. Can we hear me?
Yes, sir.
Yes, sir.
Okay, yeah, thank you. Yes. So we have the name of, so A, compute the interest deductible in the relevant assessment here. So XYZ Limited. Computation of interest deductible for, so if you look at the question, the information relates to 2021. So that means the interest deductible will be for 2022, for 2022 year of assessment. So in order to compute the interest deductible, we first of all need to get our EBITDA. So because we are giving information about net profit, I told you when you have net profit, so you are going to add back your depreciation and also add back what? Interest. So we have net profit. So we add back to depreciation. We also have interest, these two interest, we have 1,050,000 and 1 million. So we add back all those information to get what? EBITDA. So we have what? Net profit. So we have the net profit. So net profit, 2 million. So we have the net profit, 2 million. So we have the net profit as 2 million. Then we have add depreciation. So from the question, we have the depreciation as 400,000. 400,000. Then we also have interest. We also add interest. We also have interest. So we have the two interests, Dicky Malaysia and other creditor. Dicky Malaysia, 1,050,000, other creditor, 1 million. Dicky Malaysia, 1,050,000. Any problem? Then we also have other creditors, 1 million. So when we add up all this, so we are going to add up all this. So we don't have amortization in the question. So since there is no amortization, so this will give us EBITDA. And we cannot add tax because we are giving net profit, which is profit before tax. So this will give us our EBITDA, which is what? Which is. Please, that person should mute his mic. Oh, who is that? Samiat, mute your mic. So we have that. Then after we got the EBITDA, so we know our EBITDA now. We can now know how much is the interest that we qualify for what? For deduction. Because it's not all the interest that is going to qualify for deduction. Total. So how much is the total interest qualifying for deduction? So the total interest we have the one for Dicky Malaysia to be 1,050,000. We also have other creditor to be 1 million. The total of this give us 2,050,000. Then we now so let me now go back to the question. If you look at the question, Samiat, mute your mic. Oh. Samiat, mute your mic. So if you now, let me go back to the question. So from the question, we have it as, they said based on the information provided, it was discovered that out of the loan paid to other, 450 was in respect of loan obtained to generate tax-exempt profit. There's also a condition that any income, when they say tax-exempt profit, those are that means you are not paying tax on that what income. So the law is that any expenses that you incur to generate those income will not be what? Will not be taxable. Any expenses incurred to generate a tax-exempt income will also not be allowable. So in that case, so these expenses of 450,000 will be what? Will also be disallowed. So because of it relates to what? Tax-exempt expenses. So we now say less tax-exempt expenses. So which is what? 450,000. So that is 450,000. So when you now less this, so this will now give us total. So this is now the total expenses. So that we want to remove, which is what? Which is equals to this minus this. This is 2.5 million. So out of this 2.5 million now, the law now says you cannot charge more than what? More than. The law is saying you cannot charge more than what? So no, this is equals to this plus this. Because so 1.6. The law is saying you cannot charge more than what? 30% of EBITDA. So you now calculate the 30%. So 30% of multiplied by EBITDA, 4,450,000 will give us, how much did that give us? 30% of 4,450,000. That means 1,335,000. So 1,335,000. So the amount you can now deduct is this amount, 1,335,000. So the company cannot deduct more than what? More than this amount in what? In 2022 year of assessment. So interest deductible now. Interest deductible will now be 1,335,000. So will now be 1,335,000. So SS, so there's going to be an SS because we are supposed to remove 1.6. So SS will now be equals to 1.6 minus 1,335. So SS will be equals to 1.6 minus 1,335. So that will be what? 265,000. So this is what examiner expects you to do. So the interest deductible. So after you have computed this, so the B part, in the B part, we are now asked, let me go back to the question. So the B part, we are asked to what? To do, explain how the excess interest not deducted in the relevant assessment will be treated. Don't forget, I mentioned it earlier. So what will happen to the excess interest? It will be available. Who can remind us? What do I say will happen to it? The excess interest. What will happen to it? Who can remind us? What will happen to the excess interest? I told you that so the excess interest will be available for what? For 5 years. For 5 years after the year of assessment. it occur on what? On a first in, first out basis. So B part, excess amount of 260. How much is the excess? 265,000. So the 265,000 will be carried forward to what? From 2020. So this is what? 2022 year of assessment. It will be carried forward from 2022. We now have 2022, 23. So we now have from 2023, 24, 25, 26, 27. So 5 years will be carried forward from 2023 to 2027 year of assessment on a what? On a FIFO basis. So it will be available on what? On a FIFO basis. So then the C part is asking us to compute what? Compute the tax liability. So compute the tax liability. So to compute the tax liability is very simple. So to compute the tax liability, we just look at the information. So C. So I don't think that one is not in that computation of tax liabilities. Tax liability for 2022 year of assessment. So we have SYZ Limited. So already I know that I know my EBITDA already. We know our EBITDA to be 4,450,000. 4,450,000. So since we know our EBITDA, very simple. So from this EBITDA, now this is earning before interest, tax, depreciation, and amortization. Just less the interest, just less the interest deductible. So how much do you calculate as 30% of your EBITDA? That is what, when we calculated it, 1,335,000. So we just less that from this amount. So the resulting figure will give us what? Accessible stroke adjusted profit. And we don't have, so this is accessible. So we don't, no capital allowance, no loss relief given to us in the question. So this accessible to adjusted profit will also be the same thing as what? As our total profit, which should be liable to tax. So it is this total profit that will now charge what? The tax rate on. So what will now be the CIT rate? Who can remind us? What will be the CIT rate to be adopted?
30.
30%. Why? Why are we going to adopt 30%?
I don't know.
You don't know? So why do you now say 30?
Actually, you said if the examiner did not tell us what to
Yes,
use.
now, that is the reason. So, because the examiner did not give us information about turnover, so our CIT, company income tax, will now be at what? 30%. 30% multiplied by 3,115,000. So 30% multiplied by 3,115,000. So that will give us the value for the what? For the CIT, 3,115,000 times 1. So that will be 9,345,000. So will be what? Will be the company income tax. So you may also be asked to calculate what the tertiary education tax at what for 2022. Tertiary education tax is what? 2.5%. So 2.5% of your of the accessible profit, 3,115. So you also calculate 3,115 like 2.5, 77. So that will give us 77,875. So that is how to calculate for. So that is how to calculate the interest deductible. So please, it is also testable. The examiner may test it. So as I told you, it came out as part of in November 2021. Since then, it's yet to be tested. It may also be tested by the examiner. So let us take note of that. So please, let us take into consideration so that. So any question?
Hello, sir.
Yeah?
Please, I want you to explain again where you said if you are given maybe profit after tax, we are going to add
Yeah.
depreciation. When we are given accessible profit also, we are going to add interest. So I didn't really get that, please, very well.
Okay. All right. So what I said was that, you know that if you are giving profit, net profit is your profit that you have deducted your depreciation before you arrive at net profit. You have deducted interest. You have deducted amortization. So that means for you to get any before interest and tax, that net profit, you have deducted interest, you have deducted depreciation, you have deducted amortization. So in that case, you are going to add all those three items back to get EBITDA. But when you are giving accessible profit is profit after your adjustment. And when you are adjusting your account, you will have adjusted your net profit by, first of all, adding back your what? Your depreciation as what? As a disallowable expenses to get accessible profit. In that case, that means if you are giving accessible profit, what that means is that what? You have already what? You have already treated what? They have already treated the depreciation. So you don't have any business with it again. What you are going to add back, depreciation and amortization, what you are going to add back only is what? Is the interest. You will only add back the interest because accessible profit is profit afterward adjustment. But net profit is what? Profit before adjustment, which is what? Accounting profit. So that was what I said. So I hope it's clear to you now.
Yes, sir. Thank you, sir.
Yeah. Any other question? Any other question? So in the absence of no question, so this is where we are going to end the class today. So we are going to continue next week. So also with the topic on company income tax. So thank you and have a good day.
Please help us send the Excel sheet.
Hello,
Okay.
sir.
Yeah?
Please help us send the video, the recording.
Okay.
Sorry.
They will upload it.
Thank you, sir.
The Excel sheet also.